Hey everybody, can you hear me? My system kind of glitched there for a second. Awesome, so good to see you. Tara is in the house. Good to see you, Tara. Happy birthday, by the way. Has the birthday celebrations finished, or are we just, is it the after party? Terry, great to see you. And I'm just looking through the people that are here in this room that I can see. I know Paige is here. Jim is here. Jennifer, you will be on screen in just a moment. Drew, have we met before? Give me a thumbs up or a thumbs down. No, we got to change that. Put it in the chat where you're from, and everybody else, just so I have an idea of the scope of our meeting today. I know Doug is not far from me, but everybody else, I'm not too sure. Anyway, welcome to REWL, Real Estate Wealth Lab. And Jennifer, let's bring you in right away. Let's get the show on the road. We show up once a month with our research lab, and we do a deep dive into research. And today, I believe, Tara, that we are going to be in your neck of the woods, so to speak, your neighborhood, right? And what a time when we've got to really pay attention to what the numbers are really saying and what is actually happening. But there is so much of, I think this is my second downturn in the real estate investment market that I have been through. I went through the one in 2008 and this one now. And, in 2008, when things went south, I made a lot of money because that's when I structured, I reset. And again,
did you buy, Narat?
Pardon me?
Did you buy in 2008, 2009? I
bought in 2008, 2009. In fact, we are just recently, we liquidated a property we bought in 2009 or end of 2008. My partners made 61% ROI per year averaged. That's crazy, right? Yes, this is the time that I think that we should really be looking at what is actually happening in the market, because there's so much of fear, so much of misinformation, lots of information out there, but curated information, information that is actionable, that is intelligent, that is wise to work with, that can help us. That's what we're here to provide you with, not because we see all, but because we're in the trenches with you. And we're making decisions based on what is best for our own portfolios. We're sharing that knowledge with you. Jennifer, what's going on today?
Awesome. Thank you, Naran. Right. We've got the research lab and you've gone through that. So I'll leave you with this for a starter.
Perfect. Legal disclaimer. This means that you are acting on your own accord and we are not telling you what to do. That's what it means. Take a snapshot of it. This is information we're sharing that we see, in our opinion, what is going on, but not necessarily stuff that you should be acting on until you do your own due diligence.
Perfect. And when we show, I'm going to add to that, because when we show like a buy signal or a hold signal, it means that that indicator itself is showing that performance. However, you need all 33 plus indicators to get the whole picture, which is what we're going to apply today for the do. So that'll be fun. All right, I'll move
on. Some chat rules. Do ask questions, say hi, get involved in the chat, share feedback, thoughts, but please do not solicit or sell. That goes without saying. What's next on our, this is being recorded. So it's available for you in your REWL member portal.
The smile, you're on camera. Oh, that's look right. At there, all the smiles. Hugh, Terry, Lewis, this is great. This
Even Hugh is smiling. He was looking friendly.
That's awesome. Very cool. Okay, here's our agenda.
All right, so we're going to be looking at Canada and the US at a macro level, I imagine. Is that correct, Jennifer?
Yes, indeed.
Perfect. And I am really, really looking forward to what our research is going to show, what your research is going to show today for Canada and the US, because I've got deals that are happening in real time, and I need all the wisdom I can get. And then we are going to do a deep dive into Leduc. We're going to do a market analysis, and then we'll have some closing question and answer period.
Perfect. All right. Well, shall we, ladies and gentlemen? Oh, I'm getting thumbs up. Okay, let's do it. I have a question before we get started. Please pop it in the chat, or honestly, I don't mind if you want to unmute yourself and chat. How are you feeling about the real estate market? And yes, I know that there isn't a Canadian real estate market and there isn't a US real estate market. It is very specific. However, in general, how are you feeling? Excited, says Elaine. Is anyone scared? Quietly confident. Thank you, Hugh. Excellent. It's an open-ended question. How are you feeling about real estate right now? Doug, all good, waiting and watching for deals to pop. Very positive. Okay, opportunities galore. Pretty excited. Soria, hello, that's fun. Pretty excited. Yeah, you've got lots going on. Okay, very good. And excited for, thank you, Drew. Possibilities, lots of possibilities. Yes, Tara. Okay, great, excellent. That's very, very good, because it means you're in the right spot with the right people. Yay. And getting the right information. And oh, wait, I see someone wrote nervous. Maria, perfect. We are going to talk about that today. Absolutely. Because there's a lot of folks who are nervous. And that's why you're here at the Real Estate Wealth Lab, because we've forecasted this uncertainty.
Jennifer?
Yes.
If I can just interject here just for a moment.
Sure.
I just realized that we may have, like the people I see on the screen, you guys are all old dirty shirts. You're part of REWL, and I've seen a number of you many times. So we're just kind of like plowing ahead. I just want to pause for just a minute. And if you are new, if this is your first time here, or you're brand new to our little circle, I want you to feel welcome. We Real Estate Wealth Lab, we are a group of, for a lack of a better word, we are a group of hooligans. And what we do is we do real estate investing. We look at numbers, research, we push each other. We look at the methodology behind it and what it takes to be a real estate investor in this time period. So if you are interested in making money in real estate, or if you're concerned about your wealth, then you're in the right room. So welcome. And maybe at the end of our call, I'll talk a little bit more about REWL and what we have to offer.
That sounds fantastic. Thank you, Naran. And yes, I am plowing ahead. I've got exciting things to talk about. So thank you for bringing, yes, Vincent, he said hooligans, and he also said dirty shirts. So for the record, I am wearing a clean shirt, and I'm certain that all of you are as well. So let's have some fun today. And it is great. I'm glad to see some wonderful people who are new, and I know you, so that's fantastic. I see you. Thank you for joining us today, and all the way from Hawaii to Mexico and everywhere in between. So that's fantastic. So a little bit about the real estate cycle. So this is just the business cycle of real estate. And for those of you who are new to this conversation, we talk macroeconomics, and you may be wanting, as Naren said, to go out and just buy real estate. Okay, you could do that, which is what I did before I understood what the real estate cycle is all about. And then I bought in 2008 at a high, and I got caught, and it took 11 years for that property to come back. And it rented out, and it was fine, etc. over that time period. However, had I known what you're going to know today, I would have I had an opportunity to wholesale flip the property. It was pre-sale, and I had an opportunity to wholesale it. And I would have made $40,000 in a week instead of a 9-year mistake, because that's the power of looking at this. So the basic principles of business cycle. Yeah, exactly, Lee. I'm not saying your first name because everyone can read that in the chat. So I hope that's cool. So in terms of a contraction, there's a stabilization and an expansion period, just like in any business cycle. However, what's very cool about the real estate cycle formula is that we're able to actually see the duration of a cycle. And I'll give you an example. So back in 2018, Vancouver, Canada, was experiencing a slump. And through this work and expanded, I was able to see and forecast that that slump, that contraction in that phase was going to last 6 months. Meanwhile, Calgary was experiencing something different, and I'm able to see that that was going to be a 5-year contraction period. And right on cue. And this is where I'm going to get straight to the punch, actually. This is what it looks like. This is a real estate cycle formula in its, not in its entirety. I'm not showing you everything. There's over 33 indicators that I look at. And the reason I'm not sharing it is for intellectual property and copyright. I'm working on that. Can I hear that someone, yeah, Amal, you can't hear me or unable to hear me? Is everyone else okay? Can you hear me? Okay, great. Okay, thank you. Okay, Amal, I think it might be on your end. Hope you can get some support with that. So in the background of the real estate cycle, we look at 30, I think it's 33, and I keep adding new indicators to make it even more robust and more accurate. And these indicators are weighted differently. So one of the 3 key leading indicators are GDP, jobs, and people. However, they're not weighted equally. So people actually have more of an impact than GDP. And Florida this last year is a prime example of that. And you can refer to our market analysis of Florida from December 2021 to get a look at exactly how that played out for Florida in terms of people driving their lagging indicators, which is rent, real estate, and others. So there's a theory that I've come up with. It's called the kids in a bathtub economic effect. I will talk about that later. I know, and I will show you a picture of me in a bathtub. And this is what we're talking about. They're weighted differently, and some indicators are lagging, and some indicators are leading, and then they're reversed for each other. And so it just becomes this cacophony of magic indicators out there, and we make sense of it. So that is what we apply. So when we look at this is actually a forecast from the very, very, very first Real Estate Wealth Lab in September 2021. This, you can go back and see it. And we saw and forecasted that at the end of 2022, now-ish, through 2024, there will be a softening in the market. That's that arrow. It looks like it's straight down. However, it's actually a softening. And because what we're seeing is all of the things that are coming into play right now. However, I want you to pay attention to what's circled in yellow and that long trajectory. Based on the economic indicators and the leading indicators, including all the other things that I have not mentioned here today, we see that there will be a long, modest expansionary period for upwards of a decade. Okay, so we are going to see this softening 2023 and 2024. Now, Naran always stops me and says, well, what does softening mean? So a softening essentially is where the headlines are not going to say this. However, when you do the math, it will. So in 2019, well, end of 2019, so in 2020, 2021, the real estate markets and the values went super high. For example, in Canada, the average was upwards of 45% increase in price value. Similarly, in the US, upwards of 20%, 30%, in certain markets, even higher. So what we're seeing is a softening because we are going to go back to previous levels, sort of in that pre-2020 level. However, it's going to be still a net high. So we're not losing that much ground. We will not lose as much ground as we have gained, is what we're getting at. Okay, so I hope that clarifies. Now, many of you know that I have my master's degree in communications, and I actually studied sensationalism in news. That was my master's thesis. And so I'm freaking passionate about bringing you the real news and getting behind the headlines and getting to the data so that you may have the truth. And this is for you because I care and because I'm also a real estate investor. And so this is for my business as well. All right. And I follow my own advice. So here we go. GDP. So this is where we go through all of the, not all, many of the key ones that we want to be looking at. So we're going to touch on GDP, economic activity. We're going to touch on jobs. We're going to touch on people. What's the immigration doing? Then we're going to touch on inflation and interest rates, rentals, and property prices. So those are the seven major sections that we're going to talk about for a macro level. So in GDP, what we're seeing is the US has revised down again. You can see in September, the forecast was 1.8 for 2022 forecast. It's now been revised down again based on this one source, Scotiabank, down to 1.7. However, I need to remind you that this is still growth. And this is very, very, like it's not amazing news. However, it's good news. It is growth because property prices about 2 years later follow GDP amongst all these other. So again, this shows on its own as a buy signal and a hold signal because we'll see this pop up in our rents and our property values down the road. Canada has revised up. So it was 3.1 last month, and now the revision is up 3.2. This is very good. This is very good news. So GDP is up. Oh, pardon me. And yet in this particular Reuters, so that was Scotiabank, again, what we look at is multiple sources so that we get a version of the truth. Yes, and for fun, I have actually gone, and you all have had this presentation at some point where I put all of the banks, I think I did it last month actually, all of the, not all, many of the banks or many of the economists, and I put all of their forecasts side by side, and it's very easy to start seeing the bias and then finding out the truth somewhere in between. So in this case, oh yeah, this is funny. So Freeland is our Canada's Minister of Finance, and she unveiled an economic update slashing the 2023 GDP forecast to 0.7%. Now remember, I just said here, so 2023 for Canada, the forecast is 0.6%, right? So this is where they're forecasting that recessionary period. And so GDP forecast 0.7. She also said the economy would avoid a recession. Again, 0.7 is still growth. It's just smaller. And I'm just going to skip ahead on this. So a couple of little things. So why this is good. It's right in saying that there's potential to avoid recession. There are a lot of factors that are really showing up, and you're going to have that data today that are suggesting that a recession will be very mild. And again, data last month also said this too. The recession, there will be one, it will be mild, and it will likely be very, very short. So what to watch out for in that particular news article is a source reliability, quite frankly, and sensational, like slashing, you know, it's not slashing, it's still growth. Like, let's put on a different spin. So what we know, we are expecting that, I've just mentioned it, we know that duration, we're expecting it to be mild and short. And recall that much of this is, yes, I'm going to say it, a self-imposed recession. Thank you, lawmakers. And we'll be talking about how this, oh, Tara's like, yeah, nodding. Yeah, when you spend and print money and give it to people when the economy is shut down, that creates a recession. So we knew what creates inflation, which creates the recession. So we knew all of this from March 2020. Now, again, these are still showing positive growth. So we want to recall that rent and property prices follow this indicator. So 1 and 2 years down the road, there's still going to be price growth based on this indicator alone. So this is a buy and hold signal. And again, we don't base it on just one, we look at 33. So when it comes to the US economy, it bounced back last quarter after shrinking in the first half of the year. This is incredible. You know, there was all that doomsday talk, and it's coming back up. Now we're still watching it closely. So again, we're looking at a deflation, I don't want to talk about deflationary in terms of inflation and deflation. No. I mean like deflate, as in the balloon in the gift down here. We will see that recession occur. We had that life jacket economy. In other words, the governments in both US and Canada came in, attempted to save the day and do all that spending. And now we are seeing the results of that. So we're going to have a little deflation. However, that that balloon, our economy in North America, is not expected to burst. And I'm going to show you some real data as to what we're seeing there. So, and again, for those of you who, yes, everyone is seeing doom and gloom, and this is where you're here. So I'm very excited to have you here. Now, something to consider is that inflation is actually a friend of real estate, and real estate is actually a friend of inflation. So when we have an inflation, and we've had multiple, who would agree? Pop it in the chat. Have we had some turbulent times lately? Yeah, okay, I get a lot of thumbs up. There's been wars, there's been pandemics, there's been, you name it, crisis after crisis. And the data show, and historical data show that in inflationary times, as well as in turbulent times, real estate typically outperforms. And that's a double buy signal for us. Now, the other thing about inflation is that at minimum, real estate typically actually goes, it not only appreciates at the same level as inflation. We're going to talk about inflation today. So it appreciates at the same level. It often outperforms inflation. What other assets do that? Not very many. So this is one of the things we always want to keep in our minds as a savvy real estate investor, is that we want to be taking advantage of these times. So that is definitely a hold signal. Hold signal. You want to be holding on to your real estate. So when we plot it out, again, this is the map version, easier view. Vincent has seen the spreadsheet. And it's going to make it with, as our chief technology officer, we're going to make it into an app that will be available to you at some point, which will be very cool. And so we plot that in there, and we're seeing upward pressure on our lagging indicators of rent and real estate down the road. Okay, so jobs, Canada. Remember how scared we were this summer? June, minus 43, July, minus 31, August, minus 40, and then, oh, 21,000 up in September. Look at what happened in October, 108,000. We're good. We're back on track. This is excellent. Of course, we're watching it. We'll see how November plays out. However, that made up all, it recovered, and it made up all of the difference that was previously. Unemployment is holding steady at 5.4. That's good, actually, and that's a benchmark, ladies and gentlemen. If you didn't know this, 5% for unemployment, and this is for US and Canada, that's a sign of a healthy economy. You don't want it necessarily too low, and you don't want it too high. So 5% is a very good benchmark. We're good with that. Participation rate also improving. And like I said, remember the participation rate, it was last January, where our labor force, in terms of the participation rate, that's the people who are choosing to opt in to be, employees, was back to this pre-government shutdown for the COVID-19 situation. So as a result of that, this is even like, now we're way ahead. Not way ahead, we're up. This is good. This is very, very good. And wages are also up. So every single one of our 1, 2, 3, 4 employment data here, and again, I look at more than just 4, all of these in summary are up and favorable. And again, these are leading indicators forecasting where we're going to be. So here's just that it's showing that the economy added the 108,000 positions, and blowout and all this. However, I highlighted here because this is the part that really, really gets me, and I really encourage you to become a Real Estate Wealth Lab member, because we were not surprised. Anyone here? I was calling it this summer. I'm like, these numbers, they're low, and there's nothing else in the economy and the indicators that are suggesting at the moment that those unemployment numbers or lack of job growth would be sustainable. And here they are. So when it says, oh, surprised forecasters, well, like I said, you are all qualified to be a forecaster. So that's really, really good. Like I said, I am really wondering who these expert forecasters are. We had this handled years ago, and we've got you. Now, there's the other side of this little situation here, is that as jobs improve, as it goes up, then we actually, the way it works right now in inflationary times, and please check out previous Real Estate Wealth Lab research labs, because I go into it in great length, and I'm not going to repeat it here in great length. However, if this is of interest to you, we've got lots, and I can help show you where to go to get information on it. Okay, so what happens when inflation occurs is a recession is a byproduct. It's an outcome. It's a side effect. That's what happens. We have inflation, and there's only a handful of ways to improve inflation. One is for the government to stop printing and spending money. That's number one. Yep. Number two is to raise interest rates. So that's how interest rates and inflation are very much linked. However, they're leading and lagging indicators, and they take about 2 years to influence each other. So when this happens, what we see is, okay, the Federal Reserve in the US and the Bank of Canada, the central banks go, oh, well, if jobs are still growing, then that means that people are employed, and that means that people can handle higher interest rates. So it has another impact where we now, okay, we just got jobs data and they're growing, great. Uh-oh, now that impacts interest rates, and we will be seeing higher interest rates, and I'll talk about that in a moment. Hope that is clear. I saw a lot of nods, so this is good. And so same thing in US, like remarkable strength of the US job market, 261,000 jobs in October alone. And this has steadily been, I mean, they've had record breaking numbers. I think the last few months, it was upwards of like 300,000, 500,000. I mean, massive job numbers. So here's some of the stats that I like to show for the US just month over month. Again, positive signs for jobs, little like, GDP is just so. However, jobs are still there. So this is very good. Also, I've been pointing out productivity for a long time. This is something that nobody else is watching. So since January last year, I started watching productivity. And do you know that it was at a -7% last January? What that means is when the employment is growing and jobs are growing, however, if productivity is going down, we've got a problem, because it will not translate into the same economic output. That's not happening anymore. Look at this productivity. Boom, 0.3% improvement. All right, so we're cooking with some gas over here, which is awesome. Again, it's just like maybe a 1-burner stove. We don't have the big, huge Bosch, whatever, but this is really, really positive activity. So again, those headlines out there, I know are scary, and we don't need to be in that conversation. Just read your newsletter. Which should be out today. It's Wednesday. Yes. So there's the Real Estate Wealth Lab intelligence report comes out, and there's lots of interesting information in there that goes even deeper. So why a booming jobs market may mean a rough road ahead. And that's what I was just describing, is that jobs go up. Therefore, the Bank of Canada, or in the US also, the Federal Reserve, will also feel more confident in raising interest rates. However, I've got a little like laughing emoji here, because I just love the way they word this. Like, let's take some accountability here. Listen to this. If the economy isn't actually slowing, the bank may be forced to move even more forcefully when it makes its next policy decision for interest rates. Be forced? Come on. We are leaders in this country. Well, yeah. One day I'll have a little chit chat with these folks. There's no being forced to do anything. Our leaders need to take sound economic policy decisions. So yeah, all right. Who wrote that article? Oh, CBC. No comment. All right, so what it says is, we said it first. So again, we said all of this over a year ago. Because that's when we opened our doors, is a year and a couple of months ago. However, we've been forecasting this for a long time. Since March 2020, we knew we would see inflation. So there's no surprise here. We knew that there would be the side effects of that inflation, there's a recession, and interest rates are going up. The jobs are high, so we're gonna have those interest rates higher, and that means that higher inflation, prolonged tightening by the banks, and more interest rates. So interest rate hikes. So there we are. Expect it. Oh, haha. So this is what I'm talking about. The kids in the bathtub economic effect. So you know when you got who here has ever taken a bath, you know, with your cousins or whatever, and one kid's going this way and another kid's going that way, and you've got water splashing all out of the bathtub. Anyone? Your kids done this, whatever. Okay, excellent. So that's what I'm talking about here, is we've got interest rates going this way. We've got inflation going this way. And interest rate is going to impact your inflation rate. However, the interest rate hikes, they're not what's impacting our inflation rate right now. You want to know why? Because it takes 2 years to go through the system. It takes 18 months minimum for that to have an impact. Well, we only started raising interest rates in the spring. Oh, Tara, you've got mom photos with your kids. Exactly. Yes. And that's me in the top right-hand corner with my brother. I should probably ask my brother's permission. Love you. Anyways, so at any rate, it's so is that inflation going or is it interest rate? And they take this time. And so, and then the jobs. Oh, so jobs are high. Okay, so interest rate's going to go higher. And some lead and some lag and they go like that. And that's what I mean. And so ultimately, it's whichever indicator right now is going to get tired out the fastest and stop swishing around in the bathtub. So that is the kids in a bathtub economic effect. And that's why we weight our indicators. That's why we look at 33 plus indicators, because they are having different interactions at different times. So hope that's clear and fun. So when we plot it in our real estate cycle formula, it's an upward trend. Jobs are going up, and they have been, especially hugely in the US. Now, that's not to say that something can't might not happen at any moment. These things, policies or a lawmaker can happen, and that's why you got to keep coming back so you can stay informed, and we will share with you what a change of forecast might look like. So people, now we're going into people, and people. Such an overlooked indicator. It is truly, I've got a beautiful quote, and I probably won't say it perfectly. However, it's along the lines of people bring prosperity. Where people go, they create jobs, they buy things, they create economic activity. That's where GDP comes from. That's where jobs come from. So if you actually follow the people, you're going to have everything else for the most part. So that's it's a very much a leading indicator. How's that? So what we're seeing in Canada, we were starting to see an increase in immigration, like true immigration, not the fake immigration. I say that last year because what happened is they just reprocessed. So permanent residents, yay, they got their permanent residency, which is awesome. However, they were already in Canada. So that's how that worked. Now we're starting to see individuals coming into Canada, and that is important for us because people rent and people buy places. So we're seeing the highest proportion since Confederation of immigrants in Canada. Okay, flip to the US. Record high of foreign-born population. Okay, all right. So what does that mean? This is really, really good news. We're seeing that from a number of perspectives. So we've got a resurgence of immigrants. We have that, and that's helpful. And we're going to talk about real estate in a second. That's very, very helpful for the economy also, because a couple of research labs ago, I showed you what the world fertility rates were. I don't know if you recall that. And it is not good. It is really not good. And Elon Musk actually recently said that the biggest challenge to Earth right now, to the world, is population collapse. So that is a risk that we outlined, I think it was August, this summer, and we're watching that very closely. So we want to be, because remember, our real estate is driven by people in a very big way. We're in the people business. So we want to be watching that forecast. So when it comes to immigration, This is excellent. We want Canada and we want US to be attracting. And by the way, as a reminder, the US is the #1 country for attracting immigrants. So that's very good. Canada is highly dependent on immigration, however, is not #1. So there's some work to be done there. And so when it comes to the actual real estate and properties, population, people move in, and also when they're immigrants, they're already typically at the level of being an adult, so they're renters, as opposed to babies take, you know, about 18 years or so to be a renter. So this is good. This is, we're real estate investors. And they need a place to live, to rent, and then you typically, so, well, I won't go down that path. I have so many stats. I've mentioned them before. They will typically rent for about 3 years and then they buy. So that's fantastic. And this puts upward pressure on both rents and real estate. So this is just a little stat graph for you. Again, it's good news for the economy and of course, real estate when we're benefiting from immigration. So this is excellent. All right, so we're plotting that. Okay, see how these pure leading indicators are putting upward pressure. So when we start thinking of headlines, okay, we're not getting into the headlines yet. With the interest rate. Okay, so again, Scotiabank forecast tables revised up again. We called it here. We've been talking about it for a very long time. So harder, better, faster, stronger. You guys, we've talked about this and the Daft Punk song. I believe I've even sung it for you. So this is here to stay. Higher interest rates are going to be around for a while. So the Canadian interest rates, here's where they're at. October 26th was the latest and greatest. Percentage change up 0.5 to the target is 3.75. US interest rates, the latest and greatest is from November 2nd, and that went up. It was 3.25%. It's now 4%. I have something I want to share. And I'm just going to put this out to the community. So I'm going to ask you a question. So pay attention here. So what happens is, oh, there's so what happens is, why are we talking about the Federal Reserve and the Bank of Canada and the Federal Reserve in the US? Central banks set this overnight rate, and that's for the banks. So this bank is what we're talking about. This is a policy rate. And the banks, they don't go by this number. The banks actually create their own because they are paying whatever they're borrowing from the central bank. That's their interest. And then when they lend it to us, say in a mortgage or a loan of some sorts, they then charge more because that is their margin. That's their interest rate. Is that making sense? That's how they make money. Okay, cool. So typically when the overnight rate goes up, then the banks will charge more. That's usually how that works because they need to make their spread and they have things that they've got to do for their stock shareholders. Okay, however, one more situation just occurred recently, and I have a mortgage. I won't say the financial institution. I have a mortgage in the US with a US financial institution, and they just recently sent me a letter. I don't know if anyone else has gotten this kind of a letter, and they said that they are no longer using. So that's what they do. I'm sorry, I'm going to back up. So that's what they do. The Federal Reserve, the Bank of Canada, they do that for their nation. So Canada and the US. Now, there's an international overnight rate. It's called the LIBOR. It's set in the UK. And that's what globally the banks charge each other. And I just got a letter from my mortgage, US financial institution, that said that they're taking that and they're not going to go with the LIBOR overnight rate anymore. So what are they going to set it to? I'm just curious. If anyone else has had a letter like that, I will be digging into it, obviously, because this is what happens. We've got to find out what's going on. However, I'm just popping it out there. Something has changed, and I'm going to find out what's changed. All right. So here's the latest and greatest for US rates. So these, again, got to talk to your mortgage broker. However, this is about what the banks are now charging. So I showed the overnight rate, and this is what the banks are charging. This is just, again, honestly, I needed a laughing emoji on this one too. So the Bank of Canada is now, it doesn't matter the headline, adopting a meeting by meeting approach on interest rates. In other words, they're going like taking it day by day. They're focusing on it so closely to manage these interest rates. And then look at this, quote unquote, we do not expect the rates will need to go higher to get inflation all the way back to inflation target. Please remember that. Write that down. I will bring it back to you because we are going to see interest rates continue to at least hold, if not rise, through next year. So there we are. Now, that said, they will not rise for forever. There is a certain cap, and I have mentioned this, and I'll just briefly touch on it, is that because both the US and Canada, however, Canada especially, is Canada's economy is 1/5 made up of real estate. As such, they will be very mindful not to kill Canada's GDP by raising interest rates too high. So, and also both banks, the Federal Reserves, the central banks in the US and Canada, both of them have they have a lot of debt. So if they raise the interest rates too much, they being us, the taxpayers, will have a significant amount of debt. So they'll be managing that. What exactly, I'm just getting a question here. What exactly is the inflation target they're looking for? Oh, the inflation target is 2 to 3%, 2 to 4%. It's 2 to 4%. It's been at 2% for years and years. And so that's their target. And it's currently, well, I'll show you just a moment. So anyway, there it is. I do have the laughing emoji. So they finally admit that inflation exists. Now, why do I laugh at that? Because you'll recall that they said all of these, whether it's Bank of Canada or whatever, I mean, you heard it, the narrative, the headline narrative, the, what is it? The consensus. Yes, the market consensus from all of the bigwigs said that inflation is transitory. You remember that? It's not transitory. And they also said, this is January 2022, the market consensus said inflation would disappear by the end of 2022. Okie dokie. No, because that's not how economics work. So inflation is not even close to over. That means interest rates are not close to coming down, and they're likely to go higher. So good news, again, real estate typically, I'm not gonna say always, typically outperforms inflation. So that's exciting, very, very exciting. So now in terms of inflation, the US, just a second, I'm just gonna, there we go. So it's actually trending down a little bit. This is good. However, it's still at 7.7, and you'll recall that the target is 2 4%, ideally at that 2. So still high, and it's expected to stay there for some time because, again, even with the interest rates higher, it takes 18 months for that to really have a true impact. And we only started raising rates, this spring? Yeah, January, yeah, so this spring. Okay, so then so then you can see in Canada, similarly, it's holding steady at 6.9%. By the way, so as this translates to real estate, think about it differently, put on a little different hat. I know inflation can be a challenge, and my heart goes out to all of those who are struggling at this time, particularly around Thanksgiving, and that definitely is, something that I am very motivated by. I want everyone to have financial freedom and their life by design. I'm very passionate about that, and real estate is one of those ways to get that. And what I'm showing you, going back to these inflation, is remember I said that real estate at a minimum performs as well as inflation. So even when the headlines say, oh my gosh, it's dropping 20%, well, inflation is 7.7%. So just that alone, regardless of the market, will have a positive impact on real estate. Okay. So this one, inflation relief checks. Oh, oh no, I won't go into it in detail. I think I recently went over the Inflation Recovery Tax Act in the US. So I go into it in detail. However, so the US government has basically placed how they're getting out of inflation is by printing more money. Okay, that's the plan here. They're printing more money and doing more stimulus checks. I know. Maybe one day I'll be able to have some conversations with some of these lovely lawmakers. Okay, so for those of you who don't know how ludicrous that is, here's a quick pulse note on how inflation is made. So inflation is made by the government printing and circulating money when the economy isn't performing very well. They've just downgraded the GDP. It's okay. It's not, it's kind of chugging along. And guess what they're doing right now? For their way to combat inflation is to print more money and circulate it. Therefore, the government is creating the conditions for more inflation. This is a major problem. So heads up. Now, again, it's not a major problem if you're holding real estate because it will rise with inflation, but we need to be mindful of those interest rates. So there you go. Okay, so inflation is right on schedule. It arrived on September 2021. And I actually have a case study from that month buying things for my rentals, showing how much it raised in 3 weeks. 33% on goods that I acquired for my short-term vacation rentals. Yeah, so we expected that. Okay, so tightening monetary and fiscal policy to avoid entrenched inflation. This is what we should be doing, and the government ought to stop spending. That I'm just going to leave it at that. Again, I'm actually going to use the word. I'm concerned how these the level of sorry, I am going to just say this. I'm not sure what schools these folks went to. They have missed the inflation mark so much. And these forecasts, like by double, like from, hey, we're not even going to have inflation to forecast, like inflation is double, but it's really, really ludicrous. So please pay attention to the Real Estate Wealth Lab. Thank you, Catherine. Exactly. I think there's a major, she says, I think there is a major industry that the government has stopped counting in the inflation rates since several years ago. Exactly. Like they're not paying attention to it. So what we know, because we're in it, is that we will be seeing a persistent core inflation for some time. And this article was very good, and it actually talks about how so few people understand just this basic principle of inflation. And again, you don't need to, just make sure that you're aware of it and come here and we can help educate you so that you don't have to spend the time learning it. So now you know inflation's around and inflation is good for real estate. So there you go. And hang out with us. All right, so rental market stats. Just rentals from November, rentals.ca. Look at these up year over year. By the way, again, I contributed to rentals.ca annual report I have for a number of years now, and in it, my article or my section of the report was that rents will be going up for a long time because of the real estate cycle formula. So there you go, and that's published as well. And here we are. We can see it in the data. November 2022, up 11.8% year over year. A couple of little variations. So this is the previous. This is October versus November in Canada. Kind of on track. A little month over month decreases here and there in Vancouver and Toronto. Not worried. Look at the year over year. Oh, and Burnaby. Look at that. 27.5% year over year. We did Burnaby as our city market analysis last month. So if you want to learn more about that hot up and coming community, and yes, I am an investor there, and yes, I would like more property there. I have really amazing short-term vacation rentals that a strategy and a concept that works really, really, really well in Burnaby. Okay, all right. All right, so now the US. Similar story, not quite as high in terms of year-over-year increases. However, we've seen them in certain markets like Florida, upwards of 20 and 30% even year-over-year rental increases. However, on the average, we're still seeing it up pretty well. So October up 7.8% year-over-year. See how this data just is not the same as the narrative out there. It just isn't. So again, rents are lagging indicators. So this is based off of a year ago and all of the population and the GDP and things like that. So this is great. We're expecting rents to keep on, stabilize. Like I said, see, it's up. It's just not up as much. And we're going to see that throughout 2023, 2024. And then again, expect rents to rise for the foreseeable future. And be sure to look at your specific market. So when it comes to the property, oh my gosh, the property market. Freaky headlines. Oh my gosh, US prices could fall as much as 20%. It doesn't matter if it's US or Canada. It's the same narrative right now. Okay, so interchange them. Oh no, Canada housing market in a free fall, US in a free fall. It doesn't matter. The confidence is a challenge. However, we're still seeing that the average is still up net pre-2020 because there were such highs in 2020 and 2021. So yes, there are challenges, and I do not mean to dismiss them or in any way disrespect at all, because some individuals who might have bought at the high last year, that could be challenging. And this is where hold signals. Hold. Do everything you can to manage those for cash flow, to get every ounce out of them and hold onto them, because this will pass and it will be a long upward climb in the expansionary period for real estate. Yeah. Okay. Now, Canada. Yeah. Okay. So sales are up. The housing price index is down 1.2% on a month-over-month basis. However, that's the smallest decline since June. The price average is down 9.9% year over year. However, remember the average price was, I believe it was 50%. I'm going to err on the side of caution. It might have been a 45% Canada average. So again, up 45%, down 9.9%. We're netting okay. I understand and respect every market is different, and that's why we're going to get into a city-specific market. However, on the average, on the whole, things are not as doom and gloomy as many expect because we look at the data. Oh, I'm sorry, that says September market. It's September and October. You can see that there. So this is in the US. You'll see, so September is on the top and October is on the bottom. Still year over year, 13% year over year. It was 14%, 13%, still up. The top scoop of ice cream. Yeah, exactly. So 51 days, so 13% year over year, days on market. It's up just a little bit from last month, and active listings is up 33%. So there you go. That's what we're seeing in the real estate market there. Oh, here's, I actually included it I talked about this last month, and this is an example of bringing together forecasts from various different entities. I've done this for banks. I've done this for all kinds of different things. And this is just an example of entities like Fannie Mae, Freddie Mac, etc., in terms of home price forecasts for 2023. And you can see that most of them are expecting, this is for the US, are expecting housing prices to increase next year. So I'm not alone in this. All right, and neither are you. So again, I've mentioned this a number of times. The conclusion is buy during the softening. Make sure you're well capitalized, buy for profit or for positive cash flow, and certainly at a minimum, do everything you can to hold through these inflationary times. Get through this softening and hold through that decade of a long-term expansionary period. Okay, now, again, just a little bit, beware of those headlines. They're confidence crushing headlines. So you're going to hear the crashing. You're going to hear falling off the cliff. I've shown you some of them. Meanwhile, you know better. We've got a significant lack. I haven't even talked about supply today. I have a whole report on supply, my people. I haven't read it yet. It's here. I'm collecting the data. It's pretty significant in terms of the lack of supply and the expanding population. So there's so many indicators that are putting upward pressure on properties. Just hang tight and lean on us. You know, the real estate market is shifting. It's absolutely confusing, and we absolutely can help you navigate these times and this confusion. And I, on a personal level, and I know on behalf of the entire Real Estate Wealth Lab team, we want you to make informed, confident, timely decisions in your market. And you can. You absolutely can. You do not have to repeat the same mistake that I made on that condo in 2008 that took 9 years for me to recover from. I mean, it did okay, like I'm saying. However, I could have made 40K really sad. So lean on us, your trusted real estate professionals at the Real Estate Wealth Lab. So here's some do's and don'ts in this market. Do buy and hold, especially as we're seeing this, 2023 and 2024, a little softening in certain markets. Do agreements for sale, options to purchase, vendor takebacks work all the time. Love those. That's in the US, it's more typically referred to as seller financing. In Canada, it's more often vendor takeback. It just depends. It's the same thing. Be cautious about rent to own unless you're an absolute frickin' professional. Just be cautious of it for the next little while, or do it for a very longer term. Be cautious of fix and flips right now, or burrs, or any of that. And I wouldn't consider really agreements for sale or anything like that at this time. So there you go. Now you know what to do. Yeah. That is our macroeconomic section. And hopefully you got to see, did I make the connections to real estate, of why we're talking about GDP and how it matters to real estate? Yeah. I'm open to feedback on how to improve for sure, because I know it's a lot to take in. Oh, awesome. Okay. Very good. Okay.
Jennifer, that was a lot of information there.
It always is.
It was, but one of the things that as even as a seasoned investor, like a number of us are, when you're in, I think you used the word headline, confidence crushing headlines. We all feel it. We're all buffeted by it, and as a result, we've got to keep coming back to what are the facts, what are they telling us, and just stay the course. Jennifer, I've got a quick question for you. Earlier on in your presentation, you said to stop inflation, one, the government has to stop printing money. Two, they have to raise interest rates. So we're doing one of the two things. There's a third one, which I am certain you mentioned a few meetings back, and that is innovation.
Correct.
That during recessionary times, innovation really kicks in. And that's when, like Netflix, for example, started out of an economic downturn. Trader Joe's started out of an economic downturn. Like a number of big companies start when the economy is down. And I've also noticed that when recession hits, or when we are going through the times that we go through right now, for real estate investors, we tend, it becomes very clear. Like for me, it's really clear what is strong in my process and what the weaknesses are. It's like night and day. I can't ignore it. And for other people, I'm also seeing investors that didn't know what they're doing, and they're in trouble now because, I think it's Warren Buffett who said, when the tide goes out, who's swimming naked. Well, now we see it. I'm wondering, when you talked about in the US, you talked about productivity being up. Is that productivity being up anyhow linked to innovation? Or is that just productivity on as itself?
It can be. I haven't correlated productivity and innovation. I could see if there's something in behind that. It's more with the output. So I'm not sure that it actually, if there's something that's innovative and that raises productivity, it could be. It could be.
What I'm looking for is, during the present turbulent times, have we gone through enough pain for innovation to now start ramping up and showing up? Are we seeing signs of innovation yet?
Oh, Well, I see what you're saying. So then the productivity is definitely improving, and therefore one could deduce that likely there's some innovation there. I haven't, here's the tough part. Without going into Vincent, I see you. So, okay, I'll just finish this thought. Without going into it very, very deeply. And so here's where I go with market analysis, right? Like I've actually looked at markets and I've called the darn employers and gone, okay, what are you doing? Like if it's a mine or if there's just a few industries in there, I've actually called them up and gotten their business plans and their projections and things like this. Like that's the kind of level. So in order to kind of, and I also want to share that the news doesn't typically cover positive things like that, in case you hadn't noticed. That's why I tell that story, is without going in and actually, really getting clear on what's happening in a market or with a particular company, it's hard to show or see innovation. That productivity measure might be a good one, to your point. I'm going to check into that. And then another is diversity as well, economic diversity. So, for example, I know we're going to talk about Leduc. Like Leduc is a fantastic example of innovation. Like they've got some, I know. Well, actually, that's a great, wait, Vincent, you wanted to say something.
Absolutely. So give me a second here. Hope they could see me. One of the things that we consider, for example, in Alberta here, when times were getting tough, right? And recession, we run into recession, oil's not going out anymore. What ends up happening is we had to innovate. So our government did innovate. We brought a whole bunch of tech jobs in to both Edmonton and Calgary. Calgary for sure, tons more than Edmonton. And it's changed the outlook of what we're doing. We're diversifying what Alberta is doing, thus driving business into Alberta, driving people migration into Alberta as well, and into all those different sectors, including Leduc and right across the board. So was there productivity first or was there innovation first? Well, we had to change the game to innovate, to bring in productivity, to change the game in Alberta. And I think that's how I would see that one for sure.
Excellent. That's exactly what I was going to say. And it's great to hear it from you because that's fantastic. I concur 100%. And we've got the data to show that.
Absolutely.
Anybody want to see it?
So before you go there, I just want to remind that we actually have two specialists that are in that area in Leduc, and they're on the call, which is Mike Sherray and Tara Flynn. They're both realtors kicking ass in that area. So I just wanted to let you know, because I didn't want to forget mentioning them, and they are here to support us as well. So if there's questions for them as well, if anyone has, I just wanted to let the people know. So thanks, Jen. I'll hand it back to you.
Very, very good. Thank you, Vincent. And hello, Tara. Hi, Michael. Wonderful. Mwah. Glad you're here. Yes. Elaine Thompson. Well. Tara is awesome. And so are you, Elaine. That's fantastic. Lee, you were asking, before I go into this, I'm just going to step back. There was a question in the chat about agreements for sale, and Maureen, you did so well on answering that. So thank you. Agreements for sale at this time in the market are good as a buy because you're agreeing to, but as a sale are bad. And what that means is if you're agreeing to sell it at a price today and it's likely going to go down, you're going to lose. So that's why agreements for sale to sell, not the best. You can make anything work, by the way. Just it's something to be mindful of. That's something that you're going for. All right, Elaine, you're in Edmonton too, aren't you? So I wonder if you invested in Leduc. All right, well, here we are. Market analysis, Leduc, Alberta. Okay, so just so you know, we're just getting started and we've done a lot of market analysis. So every month we do one market. We can do more. And let's see, we've had individuals, I was just looking. So Hugh asked for Atlanta, Tara asked for Leduc, and here we are. So you just ask, and guess what? We can do it. So, you know, and these are just a sample of some of the markets that we've done. All of these market analysis and the data, and this is where I think it's really powerful. What we do differently at the Real Estate Wealth Lab is we provide you with the data. So now you will have access to this presentation and to the data and the source and be able to share this with your clients. You can even pop it into a joint venture business proposal and go, hey, here's your data. So that's very, very powerful. And again, when we look at the real estate cycle of a particular market, now we just did the macro, national level, kind of global, if you will, in some cases. And now we're going into our city level. So we always look at the nation, we look at the state or the province, and then we look at the city. And we even look into the neighborhood. We're not going to go into that level of detail today. However, we're going to look at the city. And now what you want is you want your neighborhood to outperform the city. You want your city to outperform the province or the state, and you want your state to outperform the nation, and you want your nation to outperform the global market. And that is a home run. So this is some of the things that we're looking at for sure. Okay, very good. Oh yes, and if you'd like to connect with Tara or Mike, thank you for popping that in the chat. realestatewealthlab.com/pro-network. We have a pro network, and these folks are pros. Very much. I've known you both for a very long time, and very, very cool. So then back to the real estate cycle, which is the business cycle of real estate. We plot it. And again, there's a huge spreadsheet that goes on in the background. And yes, I do it for every market. And and all the data points, and it's fun. And then plop it on the map. And where are we? And I am excited. And Tara and Michael, you haven't seen this presentation yet. So here we go. All right, again, like I said, and they're weighted differently and they have different factors. And this is not referring to Leduc right now. This is an example of what's going on, and we plot it. And so you're going to see this in just a moment. So we're going to get into, now we're into Leduc. We're going to get into the GDP, one of the leading indicators. So again, what we're looking at is, okay, well, how, you know, it's like a historical growth. What happened last year? Okay, Canada was 4.8, Alberta 5.1. Vincent, that's exactly what you were talking about. Alberta was leading in 2021. That's excellent news. This is the stuff we like to look at. Now, I didn't get the GDP data for Leduc at that point, and don't worry, I'm going to show you some stuff going forward. The long story about this slide is the GDP growth recovered. It's recovered net on net. We're in good stead. This is for Alberta. Like I said, for 2021 was 5.1. 2022 forecast at the moment is GDP growth of 5.9%. So we're having net positive GDP growth. This is excellent. By the way, we are one of, if not the only organization that I know of in anywhere that looks at net data. Different story. It's a very different story. And it's a far less sensational story, which is great because we want our real estate to be nice and good. So Alberta's economy to pull, this is from the government of Alberta, Alberta's economy to fully recover this year. Like it's already recovered. We're good. Excellent. Way to go, Alberta. Innovation, lots of diversification. There's really, really cool things. I'm a big, big fan, and I've been actually recommending investing in Alberta for years. 2020 is when that turned around. Okay. All right. Alberta poised for softer growth, although that, you know, it's softer. We've got some headwinds coming up next year. That's okay. But still poised for growth. It's got strong labor market, and you are going to get really excited when we talk about population growth. And remember what I was saying about population earlier. Spoiler alert. And there's a lot of pent up demand. Check this out for 2021, 2022, and 2023 for Alberta, leading Canada's economic growth and GDP growth. That's, Vincent, exactly what you were saying. And this is, remember, I said we want to be comparing the province or the state to the nation. Well, hello. Way to go. So this is very good. And see, I've got these like little thumbs up. There are thumbs up all over the place. So as you take this out to your investors, this data is for you to use. You take this out and you can, yes, absolutely. Even with oil not trading internationally and all these things, Alberta's economy, they've done some major work. And actually I spoke with the Calgary Development Officer and got their plan recently. It was amazing. I've spoken with Edmonton and Sherbrooke, Leduc. Yes, all right. So yeah, there's a lot of diversification. Okay, so now there wasn't data readily available for GDP. For when you get down to the smaller cities and get down into the neighborhoods, it's difficult. That doesn't stop us. It's called proxy time. Now, a proxy is simply when data doesn't exist, you leverage other data that are reasonably connected that would indicate the likelihood of probability. So I'm going to point out that these, yes, I applied the proxies and we are seeing, and Tara, Michael, please feel free to weigh in if you see that, do you see that consumer spending is increasing in Leduc? Thumbs up. Okay, good. So that's positive. Is business spending increasing in Leduc? A ton. Like that's a double plus. It's crazy. Is government spending in Leduc? Yes. Okay, great. Is there a growing demand for investment? Yes. Huge, huge, huge. Are exports increasing? Yeah, major. Are imports decreasing? And I didn't know the answer to that one, quite frankly. It's a bit harder to indicate. So are imports decreasing, relying on others? I don't know. Do you know? Yeah. Okay. So whatever. I put it as a negative so that it would be no harm, no foul. Income. Are business profits increasing? Yes, they are. There we go. Now we know, and that's how you do your proxy data. It's like, see how easy this can be? The very first time I did my first real estate cycle, I actually did it on a napkin. I was like, oh, that's easy. And then I got way more sophisticated. However, sorry, I've just got a piece of hair in my face here. So there we go. So now we know that GDP in Leduc is more than likely increasing, and I can confidently say it is. I also know the area very well. All right, so now we plot it on our real estate cycle formula with it weighted in the background, and it's going up. And remember, housing prices and rents are about 1 year out. Housing prices are about 2 years out, 18 months to 2 years out from this. Now, again, that we forecast the duration of a real estate cycle, so it can extend and contract. And what we're going to be experiencing, I'll get to it for Leduc. All right, so jobs. Double thumbs up. This is all, these are all amazing, amazing, amazing buy signals. So again, not right this second necessarily, it's the whole gamut of all of the indicators that we want to look at. So the labor force is up 2.3%, employment is up 5.2%, and unemployment is down a considerable amount. Yeah, from year over year, it's down 32%. This is amazing. Unemployment rate also down. So unemployment is the number of people, and unemployment rate is the percentage, just so you understand the difference there. Jim is asking, any recommendations for an investment-focused realtor in Leduc? Absolutely. So Tara and Michael are investor, and they're here on the call. They can wave. And you can access them through realestatewealthlab.com. Can you put that in the chat? realestatewealthlab.com pro-network / there you go. Okay, you got it. Tara Flynn and Michael Sherritt. Thank you very much. Okay, so this is very, very good. All of those are positive things. The unemployment rate, September 2022. Again, challenging to get like in, but again, we want to see Canada, province. Okay, so it's on this, it's on the same. That's the same as the nation. It's okay. It's okay. And again, remember what I said at the beginning when it comes to unemployment. 5% is benchmark. That's a healthy market. So this is okay. To me, that's a thumbs up. It's fine. It's okay. This, however, is an excellent trend of unemployment in Alberta on the whole. And you can see employment numbers are the red bar, and then the black is the unemployment rate. And that's beautiful. You're seeing employment going up, you're seeing unemployment going down. This is perfect. So this is a great trend. This is all positive thumbs up. Now, when it comes to household incomes, we also look at all kinds of data, I tell you folks. Median household incomes in Leduc are higher than the Canada, like the national average. That is excellent. Why? Because people like to make money. Eh? Who here likes to make money? I sure do. All right, so let's do this. So Leduc is making sort of 108,000 a year is the median household income, compared to Canada at 75,000. So this is good. Now that said, compared to the province of Alberta, there's other locations that have a higher median income, 125,000. So it's not as attractive that way. However, that's why we look at all of these things, because as I mentioned with the GDP, with all of that business activity, it's quite likely that we'll see wages increase, that we'll see more opportunities in Leduc. And we are seeing that the incomes, the median incomes, are on a trajectory upwards. They are increasing. That's also very good. And that supports the economy, that also supports affordability, etc. So this is fantastic. All right. So we plotted on the real estate cycle formula, and look at, we're seeing, again, upward positive pressure for the long haul. People, okay, drum roll, please. Tara, Michael, and everyone here who's considering investing in Leduc, Alberta. This is the green flag. All right, so Canada's population growth rate, this is 2021 data, and we're in 2022, so it's okay. Yeah, Vincent's like, what? Is Canada was 0.7, Alberta 1. That's excellent. It's attracting more than the national average. Go Alberta. Leduc attracting even more. That means that people are moving there. And that means that you're going to have renters. That means that there's going to be upward pressure on rents. That means that there's going to be upward pressure on property prices. This means get in there now. This, and like I was mentioning, the case, it wasn't a case study, it was real life time happening with Florida. The people came and the jobs were like so whatever, and then it's like, no, well, people were just moved to Florida. Well, guess what, they're just moving to Leduc also, because there's a lot of economic activity. It's a little different. So now you put all of those together, those leading indicators, GDP up and expected to be up, and forecasted to be up, jobs doing amazing, all of the data points on jobs, and the population up. Oh, exactly. So this is very, very good. You don't really need to go through this more. This is a data if you want it in terms of the population, etc. Sorry about that. Okay. Inflation. What's going on in inflation in Alberta? Again, this is not an easy stat to get at your local level. However, here's some information for they vary. So at Canada, we've been talking about the macroeconomics. Canada was 6.9%. The province of Alberta, 7.4%. Now, again, based on our conversation earlier today, a lot about inflation, it's really your call and your decision if you think that inflation is helpful or a hindrance when it comes to real estate. What we do and can confidently say is it does mean that it will feel like it's more expensive. On the other hand, it means that properties will appreciate more because they will be appreciating in line with that inflation rate. So, look at all these arrows. Everything's positive. See what I'm saying here? All right. Now, rental market, this is the important stuff, okay? And there's, as I mentioned, there's 30 indicators that we look at. However, you're getting a really, really good picture of this. Now, when I go into this next section, I gotta get this updated. So the rental market and the housing market are in that green and orange section of 2 years and 2.5 kind of years. So that's where we're looking out to, typically. Now that can be faster or slower. And when we, and I will show you where we're gonna end up. So that means that rental and property data, they're lagging indicators. Sometimes they're leading indicators. However, today they're going to be lagging. And so this is really, it's not really necessarily a buy decision. It's just telling you what's happening. Those other factors are telling you buy opportunities. Okay, so the rents in Leduc are, the trend is increasing. Tara, Michael, would you agree? Have you seen the rents up? Yeah, okay, all right, see? We get the data and across all property types. So it's lower than the Canadian average of 1,976. And that's actually good because remember that the median income was still higher than the Canadian average. So that means affordability wise, people are going to feel good about renting in Leduc because there's on average and median and all this, there's room. So their quality of life will be better. And that is an important factor, folks. And then when it comes to vacancy rate, wow. Canada is 3.1, Alberta 6.5, the city of Leduc is 2.1%. This means it's less than, in this case, as you're comparing it, it's more favorable than the province and the nation. And I'm getting the nods. Okay, so this is corroborated. You guys are seeing this in the field. It's so great to have experts from the location on verifying and validating that when we do our market research, we do it right. All right. So again, these statistics are available for you and will be in the member portal after this call. And I will update that source. I realize that I've got the source underneath of it, so I'll make sure that that's updated. So 2021 declined by 0.4%, doesn't matter. Leduc, again, we're seeing some great news. Vacancy is improved and it's more favorable. Another thumbs up. Property market. So here's just that at a glance, your property market for Leduc, November 2022 so far. So sales 41, listings, and I actually double checked these today, and so they're shifting. So just so you know, like I did this yesterday and then a couple of little changes. So the numbers don't exactly match. It's because stuff is selling. Is it not, Tara and Michael? So there's listings and things that are selling. So that means that there's movement in the market, which is amazing. So sales 41, it's down a little bit, 16%. Listings up 20%. Average price is 344,000. And that's still up year over year, 1.7%. And median days on market, 36%, and that's the same. Or sorry, not 36%, 36 days on market, and that's stayed the same. It's since last year. So that's also good news when we're seeing other markets, as we saw sort of a national average in the US at 50 days on market. So this means that there's more activity, which is excellent. So then pop it into the real estate cycle formula spreadsheet and look at where we are. I'm not kidding you. And it is so strong. Like, and I love it when I get these, like, because it is such an incredibly strong position right now of all of these indicators as end of stabilization. Well, what does that mean? It means that expansion hasn't even started yet. Now, again, the duration could, whatever, however, you know, it could be compressed. However, it's so likely to be a very long expansionary phase, like 10 years. There's a lot of growth in Leduc. There's a lot of investment in Leduc. And again, I would be buying in Leduc. There you go. All right. And I will reiterate the disclaimer, do your diligence, do your own homework, talk to the professionals who are there in the market, and now you've got a good baseline from which to form an informed decision. So I've gone through the do's and don'ts and the cautions and all the things, same. So really do those buy and holds. That's really the ultimate tactic this time. I'm cautioning on the rental owns, I'm cautioning on the fix and flips, I'm cautioning on the burrs, even though all the data is there showing exactly where we're headed and where we should be headed. There's weird stuff out there in the world in terms of confidence in the market and the freaky headlines. So we want to just exercise a little caution, just to play it safe. You play your own game. However, just be mindful not to just a little, it's a little yellow flag. Otherwise, it's all green flags. So that is the conclusion. Home prices have basically nowhere. Oh, good. Yes, thank you. Home prices really have nowhere to go except up, based on supply, demand issues, inflation, all these other indicators. There's going to be a little softening. However, over the long term, they're poised for upward pressure on real estate. And that's all buy and hold signals, basically almost anywhere. So hold on, and I'll just remind you of this final thought again. Inflationary times, real estate outperforms, and especially during crises. So there you go. Thank you very much. That is your Real Estate Wealth Lab, Research Lab with a city market of Leduc, Alberta. Now we've got time for questions.
Hey, Jen,
Yes.
let's do something a bit different.
Yeah.
I say we bring in both Tara and Mike
Yes. I
to
think
the
that's a great idea.
conversation. Let's unmute them and let's hear right from them. And Narand, are you pinned there as well? Perfect. Awesome, buddy. And where's Michael? Awesome. There we go.
Oh, and I just want to acknowledge Jim. Thank you. Yes, it's buy, renovate, rent, refinance. Oh, and repeat. Exactly. That's the BRRRR method. And I apologize for the acronym for those who are unfamiliar. All right. So thank you. Michael, great to see you.
Hi,
And
how are you?
Tara, great to see you. Thank you for being here today.
Thank you for doing it on Leduc. That's so awesome. Thank you.
Well, thanks for asking. See, folks? And maybe we should put that out. Hop it in the chat. What do you want as in your next market? And then we'll continue. Okay, so Tara, Mike, tell us what's going on.
So
Well,
before you guys jump right in
Oh, okay.
and tell us what's going on, it's first of all, Tara, Michael, it's great to see you. I see Tara a little bit more than you, Michael. I haven't chatted with you for a while. But if you are new to our room and our community, we don't put anybody up here. Michael and Tara are up here because I'll tell you the one thing there's lots of agents, but there are some agents that just have great sense of integrity and watching the investors back. And these two guys are I'm calling you Tara, you're one of the boys now. I'm calling you guy, but no, honestly, Tara and Mike, like you're two people that if I was buying in Alberta, in Leduc, you would be my go-to people because I would trust you. So I just want to put that out there because I know we have a number of people in our family here, and some of you it's your first time and you may not know who is who. Okay.
That's a very good point. And I'm going
Thank
to
you very
correct
much,
your
Tara.
language, Naran. You said would trust, and I believe you meant to say do trust.
I do trust. Absolutely. Yes. Yeah. And I'm very
Right.
picky. So tell us, Tara, Michael, what's going on? If I wanted to invest in Leduc, what's the challenges as an investor I'm going to face right now?
It depends on what you're looking to invest in, but I think supply. Leduc is only like 33,000 people. So it is a definite smaller center. So I mentioned someone here was looking for multifamily, like being that kind of a smaller center. That is a little bit more of a challenge, but there's still lots of opportunities in regards to what is available and the strategies that you're looking for. So it might take a little bit more patience if you're looking for different strategies.
What are the opportunities that are there right now? So I'm going to fly out to Leduc tomorrow morning. I'm going to get on a plane right now at Pearson. I'm going to fly out, I'm going to land there, and I'm going to say, show me the money. Where are you going to take me?
Oh my goodness. Well, there's we just changed our airport flight plans. So infills in our downtown core is going to be definitely happening. That's an opportunity, and we're growing. So buy and hold is all like we're growing in every direction. You can't go anywhere without finding new development. And the move to Leduc movement is strong. You can't go anywhere on social media without someone saying, you know, where do I get a new hairdresser because I've just moved to town. Like, so buy and hold, that rental market is really strong. So yeah. Did I answer?
Awesome. So there was another question. I think Maureen had asked it about what kind of industries are out of Leduc. So can you guys just answer that question?
Yeah, I think like obviously, like Tara said, the proximity to the Edmonton airport, as well as we're seeing a lot of the proximity as well to Nisku. That is getting
Mhm.
busy again with the oil and gas, right?
And just describe what
As well.
NISQ is, Michael.
Okay, Nisku is an area just south between Edmonton and Leduc, and right in Nisku there, it's a very busy area for oil and gas construction. I guess they build modules. They have massive module yards there. There's all the major drilling companies and stuff have sort of their headquarters around there. So there's a lot of transient workers coming through that area every day. They come up and down to Edmonton, to Leduc. Leduc is closer than Edmonton, so yeah, it's a very 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 busy spot for industrial work. So.
And
Yeah.
just to add to that as well, I think there's like 7 industrial parks around the Edmonton International Airport. So industrial parks means jobs. People are going to be moving here because, like, I think the industrial park just south of Devon, which is just west of the Edmonton International Airport, I think it's 16 quarter sections that they've rezoned to be industrial park. That's like over 5 Disneylands worth of land that they've just rezoned. Like, it's just starting, so don't, like, it's not being built, but they've literally just rezoned over 5 Disneylands worth of land to be
Oh my
industrial.
God, Tara, I need to talk. I'm so excited. I can barely communicate, which having me speechless, it's very rare. So for those of you who are looking at real estate from a different perspective, because we're often talking about homes and multifamily and vacation rentals and you name it, all the things. Industrial land is a major play. It is one of the least zoned and least highly coveted and least amount of supply. Like, you think housing supply is a problem, industrial land is the most valuable because it's in least amount of supply. So having new, like, zoned coming on board, I'm like, oh my gosh, I want it. That's awesome. And so consider, I know we talk mostly about commercial and multifamily and residential. However, industrial land or industrial projects and real estate, expand that line. Okay, sorry, I had to jump in there.
And what's interesting about industrial land is that I know that in our group here, there are some of you that are just starting out in real estate. So when I hear industrial land, here's what I'm hearing. I'm hearing a long-term play. I'm hearing the political climate being very pro. They're setting up to attract industry, but industry in itself has multiple levels. So you have the land itself, the business it will generate. As a result, GDP will go up, population increases, and all those people need places to live, and they need supporting businesses. So it has an effect down the road on housing, on commercial properties, on businesses. It's just like, it is one of the core engines that kind of drives everything.
1,000%.
What other questions do we have? Throw it in the chat. Now, if you have questions for our esteemed guest, throw it in the chat or raise your hand and I'll unmute you.
Okay, so I understand that Lee is actually Leroy Brown. Gotcha. All right, so Leroy is asking something nobody has talked about. It's the crime rates, safety, as well as airplane noise and pollution. Especially, oh yeah, because Michael, you were talking about the transient workers down in Nisku. So is there any challenges with crime rates, safety? Tell us about that.
So we do have quite like petty crime, car break-ins, but again, being a smaller center, we have a really strong community network of people watching out for everybody, like 30,000 people. The city of Leduc also had just in, I think catalytic converter theft is really big. And they actually have a new bylaw that's just passed due. If you don't have a license to sell catalytic converters, they can actually fine you. So Leduc is really trying to be proactive in regards to the crime. So
Yeah,
yeah.
we got that same issue in Edmonton here. I don't know. They
Catalytic
just like the
converters.
catalytic converters for some reason. So
Yeah.
Besides, Michael will send a whole group of guys to beat up anybody that wants to mess with you. So don't worry about it.
Yeah.
And then the question there was too about airplane noise. I think it's a lot of you get accustomed to, like, I'm born and raised in Leduc, so I don't hear the planes, I don't hear the trains. But it's just like if you live in downtown Edmonton, it's just one of those things that you don't get accustomed to. So Edmonton International Airport is a 24-hour airport. So they were very aware of the noise complaints. So we grew outward. Now we've been in negotiations with the airport to narrow our, it's called NAF contours. So the noise pass, and we so that we don't have as many noise complaints. But again, it's one of those things, if you're living there all the time, like you don't even hear it really. So
Michael, would you
Sure.
agree with that in terms of the noise?
Yeah, for sure, definitely.
How about pollution?
yeah, I live right actually over a flight, right, because they fly over my house to draw to land. So and besides the lights, you don't actually hear it. So Terry, you're bang on that one.
Yeah.
Very good. And Leroy's saying, well, and the question is, will the renters care? And I think it depends, you know, it depends on their job and what they're doing. And Tara's saying, no, they won't care. And you haven't experienced that. And look at the vacancy rates.
Yeah,
That's-
indicators are
always
strong.
go back
right?
to the data. Sorry,
Yeah,
Vincent, go ahead.
go to the data. Exactly. Indicators are strong. Go to the data, right? Listen, if they want jobs, if they want growth, you know, it's just attracting a lot of people. So but Leroy, do your homework, right? So this is what this is what the data says to us, but definitely do your homework.
We've got some questions. What neighborhoods are the top investments in investment areas in Leduc?
again, we're quite a smaller center, so you don't really see much of a spread very much between the neighborhoods. Do you agree, Mike?
Yeah, definitely. Yeah. Yeah. Because it is only 30,000, I guess you have sort of the east side and the west side of the of town, and that's pretty much it, right? So
Okay, that's
yeah.
good. And I just want to acknowledge something because this is very important to me. Population size does matter in real estate investing. So I do want you to be mindful that when you're in a community of a population that's a little bit lower, that there are some risks. So that's something to add to your diligence. However, because of Leduc's proximity to Edmonton, do you guys have a metro Edmonton? You know what I mean? So it's got a real ripple effect, and the Edmonton Airport, International Airport is there. So this, I would make an exception to consider because of that. I hope that doesn't sound crazy to you, Tara and Michael. However, that's how I see it.
So just for context, I live at the edge of Edmonton because there's land and there's the airport. For me to go door to door, and I'm on the southwest side, if I take our Anthony Henday, which is our major here highway, if we just take that and loop around to the airport, it actually takes me 10 minutes door to door. So it's just the proximity. If you talk about sprawl, and we definitely have sprawl happening, and we're pushing out towards Leduc and the airport, we're throwing we're just right there. So it's not that far. But this is exactly that ripple effect we're talking about.
Yeah. Sherry's asking, are there? Oh, sorry. Go ahead, Michael.
I was just saying that kind of leads into what Drew was mentioning there, like lower cost of entry when you're comparing it to Edmonton, but the rents are equivalent, if not the exact same, sort of rents that you're getting in Edmonton. You're going to get the same rents in Leduc. So.
Oh, very good. Thank you. Very, very good. And Sherry's asking, are there several property managers in Leduc, and what percentages do they charge?
There is quite a few different property managers, and they seem to all have different ways to charge. So definitely something to do your own research on in regards to how they charge, because I don't think it's quite standard, just because we are a little bit farther out. Some do travel. So yeah.
Yeah. Yeah. And there's most of the Edmonton managers will go down into Leduc. So
Awesome. Okay. How are we doing on time? Shall we keep going? There's a couple more questions.
Couple
Let's get
more?
through- Yeah.
Let's do a
Sounds
few
good.
more.
Okay. What about the building supply in Leduc? Are they building enough to keep up with supply or supply with demand? I mean, okay, there you go. So, is there enough to keep up with demand?
We're growing in every direction. So
yeah.
you throw a stone in one direction and there's a new community. So, and again, with the downtown revitalization, that's just going to happen. I imagine as well, like infills are just going to start. I just took a picture of like the second bulldozer of the second building in downtown Leduc. So like, it's all just going to happen now. So.
Yeah, and what's important here, guys, just and gals, just to remember, the city of Edmonton has been working for years to annex all that land between here and Leduc. So a bunch of it actually got done. So proper Edmonton just keeps on moving, and Leduc's actually fighting for land because of their growth. So it's a battle both ways. It's interesting to see that there is a lack of land, I would say. So demand's definitely going to be high, especially with all that industrial going out. And like Tara had mentioned before, it's a port of Alberta, or especially for commercial. So there's a lot of demand. Buildings going up, yes, buildings going up, infills, everything is changing out there.
Yeah, exactly. I think one good thing to add there, Vince, is I think Jen, you had in your notes there was only 150 active listings, right, on all of MLS. So right now the supply, in Leduc is definitely low, right, which makes it good for investors. So
Very good.
Just another place that people can look for research as well. There's a lot of different initiatives. Like Edmonton Global is another initiative for anybody looking to do some research in regards to investing in the Edmonton region in regards to an economic driver. So
Awesome. Very good. Justin's asking about multifamily there. I feel like we addressed that conversation a little earlier, and let's try it again. So can you talk to us about multifamily in Leduc? Michael? Tara's on mute. So Michael, I'm throwing that to you.
oh, sorry, I missed that question there.
Oh,
So
what about multifamily in Leduc?
yeah, I think multifamily is definitely a bit harder to get into in Leduc than Edmonton, but maybe I'm not sure why Tara. I think Tara's definitely probably better to answer that one. There we go.
sorry, my kids are home, so they decided to come in. So sorry about that. Yeah, so pre-existing buildings, like because we're in a smaller center, definitely something to be watching out for. But I guess it depends on how many units is for multifamily for you too, right? That's a question. Are you looking for the big, the bigger buildings or anything over 6 units? Like what does that look like for you? I guess, and it would be the next question I would ask.
So let me just
Oh, he's saying
structure
around
that.
6 units.
So let me ask you this question then. If I want, like when I look at Leduc, what I'm seeing is an area outside of Edmonton that is soon going to become, I don't want to insult any Leducans here, but it's going to become part of Edmonton. Like it's kind of like Toronto, Etobicoke, and then Mississauga. It's all like GTA. If that's the case, and given that industrial land has been opened up and all these things happening, I would look at a long-term play of developing within Leduc, either multifamily, or is there room for, like Terry on our call is really into trailer parks. Maybe trailer park might be the way to go. I don't know. I'm between trailer parks and say 20 floor, 300 unit multifamily building. Where would you start in developing in this area? Go ahead, Terry. Tara's been muted.
Sorry, my kids are home and they've just really decided that now's the time. So I apologize.
That's okay. We're human.
Yes. So in regards to like, there is a lot of room for development. A long-term play. I don't know if we're ever really going to be just the placement. I think it's going to go Edmonton, Industrial Parks, Airport, and then Leduc. So I don't know if we're ever going to be like, you know, one road we're in Edmonton and one road we're going to be in Leduc, just given the fact of the industrial parks and the airport. So there's definitely going to be an interchange that happens when you drive down the road that you'll notice. But definitely, I think there's
a true
room for
Leducan right there.
Pardon? Yeah.
A true Leducan, drawing the line.
You know, totally. It's in my blood. There's no doubt. But yeah, I think there's definite room for developers. Again, just because we're smaller. So I think it's that long-term play. I think you really got to wait a little bit though, because it, you know, you got to get to the zoning from the city, and then it's, you know, like there's a process. But over 6 units, I definitely think there's way more opportunity for that with the townhouse and the suites in the basement. That kind of product, I think, is definitely more than like your standard, you know, 24 units or those types of things. But again, long-term play as we're developing, you know, it'll come, right? So that would be my answer.
Awesome.
Okay.
Are we good?
I think we are.
That was fun.
That was fun.
Thank you, Tara, for asking for a market analysis from the Real Estate Wealth Lab. And you'll be able to have access to all of that data. And where do you find data about development market? Okay, all right. Well, Justin, it sounds like you're going to have to go to realestatewealthlab.com/pro-network and connect directly with Michael and Tara. That sounds awesome. That was super fun. Great to see all of your smiling faces again. And Doug, I just have a question. Is Carol there? Oh, he's on mute. Just a thumbs up. Carol nearby? We'll say hi to Carol. So I just found out that Doug is a member. He and Terry always vie for the very first person to be on our REWL calls. So it's always, what, did Terry make it or did Doug make it in the room first? And super fun. And we were chatting this week, and I got to meet his wife last week, and I got to meet his wife, Carol. Well, it turns out that Carol is often right next door or near you, and has heard me speak a number of times. And so it was so amazing to actually get to meet her. And why I say that is because this is really an incredible community, and I'm so enjoying getting to know so many of you so much better. So thank you from the bottom of my heart for hanging out with us and for learning and staying on this learning curve and getting our life by design through real estate. So if you're not a member yet, come on out.
Do it.
Do it. We don't have any fun.
Thanks, Tara. Thanks, Mike.
Thank you very much.
Thank you very much. Yeah.
Talk to you soon.
Perfect. Thanks, everyone.
So everybody, in closing, then thank you. And if you are new to REWL, feel free to just send us info at realestatewealthlab.com. If somebody can just throw that in the chat for me, that would be great. Send us an email and we can show you all the different ways for you to get involved, whether you want to be a full-fledged member at $99 a month or just get an online report sent to you at $9 a month. We've got you covered. But at least if you're starting in the world of real estate, especially in times like this, you don't want to do it alone, and you want people that have some scars from doing it to walk with you. So we would welcome the opportunity to walk with you. Thank you, everybody. Have a great night.